Welcome back, everyone. We're kicking off the year with a fascinating deep dive, and today we're diving into the 2025 global fixed income market.
Sounds exciting.
It is. And we're going to be focusing especially on India today. We're dissecting a report actually titled, creatively enough, 2025 Fixed Income.
Okay.
And it really zeroes in on India. And the big question is 2025 really going to be a year of opportunity in fixed income, especially in India?
Yeah, well, the report seems to think so. A lot of optimism there. But it really emphasizes that you can't look at India in isolation. The global picture is going to play a really big role.
Of course. So let's set the stage then. The report spends quite a bit of time on the U.S. and China for obvious reasons. They're kind of the elephants in the room. But how exactly will their actions affect everyone else?
Well, the report really highlights the re-elected U.S. president, continuing those America First policies.
Yeah.
And it expects those policies to actually boost U.S. growth. But the potential downside is higher inflation and a stronger dollar, which, has implications globally. Now, the interesting thing is the report suggests that the Federal Reserve might actually lower interest rates despite this growth.
That seems a little counterintuitive. If growth is strong and inflation is a concern, why lower rates?
Right. It's a bit of a puzzle. The report's take on it is that the Fed is probably going to prioritize, just keeping the economy expanding, even if it means accepting a bit more inflation.
I see.
So I think they're in a tricky spot.
Yeah, it's like a damned if you do, damned if you don't kind of situation.
Exactly. And then you get China, which is a whole other story.
Right. What's their piece of the puzzle looking like?
It's complicated. The report suggests that there's potential for growth driven by government initiatives, but the U.S. tariffs are definitely a drag on the economy.
Makes sense.
So to counteract all that, the People's Bank of China might cut interest rates and, maybe introduce more stimulus measures.
So it sounds like they're trying to walk a tightrope between government-led growth and the potential fallout from those trade tensions.
Absolutely.
So we've talked about the big global players, but this deep dive is supposed to be about India.
Right.
So how do the actions of, giants like the U.S. and China actually trickle down to India's fixed income market? What's the connection there?
Okay, so that's where things get interesting for you. The report suggests that India's growth might actually slow down a bit because of three main things. Reduced credit growth, the government's commitment to fiscal consolidation, and, those U.S. tariffs. They could potentially impact Indian exports.
So is the report saying that India's economic outlook is, not as bright as it could be?
Not necessarily. It's more of a readjustment, I think.
Okay.
So they're projecting growth rates of 6.8% in fiscal year 25 and then 6.4% in fiscal year 26.
Okay.
Which, yeah, it is lower than previous years, but it's still positive growth.
Right.
And remember, it's coming off a pretty high base.
It's all about context.
Exactly.
It's not a crash. It's just a slowdown after, a period of really strong growth.
Exactly.
So growth we've talked about. What about inflation? Because that's, a big concern globally. Is it a major threat in India?
Well, actually, the report expects headline inflation in India to fall to around 4.5% in the coming year.
Okay.
Thanks to things like good harvests leading to lower food prices.
So inflation is under control. We've got decent growth, even if it's slowing a bit. Anything else we should know about India's economic situation before we move on? What about the rupee?
The rupee is definitely something to watch. The report indicates it might weaken against the U.S. dollar. There's a few reasons for that. Strong dollar, the slightly weak growth we talked about, maybe some foreign investment outflows, and of course those U.S. tariffs. But it's not all bad news.
Okay.
The rupee has actually held up better than other emerging market currencies.
That's good to hear.
Yeah, so that's a positive sign.
Okay, so what about the Indian banking system then? How's liquidity looking?
That's a crucial point. The report actually predicts tight liquidity, particularly in the first half of 2025. Unless the Reserve Bank of India steps in with some measures, they could do things like open market operations, purchases of government bonds to inject some liquidity into the market, or by adjusting things like the cash reserve ratio.
Okay, so it's a bit of a mixed bag then. Potential liquidity challenges, a rupee that might be fluctuating, and growth that's slowing down. So where does the Indian government fit into all of this? What's their role?
Well, the report indicates that they're sticking to their fiscal consolidation plan, aiming for budget deficits of 4.9% of GDP in fiscal year 25 and 4.5% in fiscal year 26. Which is good news.
Yeah.
Because that commitment to fiscal discipline can really help stabilize the economy and make India more attractive to investors.
Absolutely. Fiscal responsibility definitely builds confidence.
Yeah.
So specifically, what about the Indian bond market? What's the overall outlook there?
Well, the report predicts a pretty favorable demand-supply dynamic in the Indian bond market.
Okay.
This is being fueled by that fiscal consolidation, also growth in real money assets under management, and there's potential changes coming to liquidity coverage ratio guidelines.
Okay.
And, there's even talk of India being included in global bond indices, which would bring in a ton of foreign investment.
Right, right. So even with those challenges we talked about, there are some really positive factors at play as well.
Yeah, definitely.
So for someone who, maybe isn't an expert in bond markets, what's the main takeaway from all of this? What should they be thinking about?
I think the key takeaway is that, despite some challenges, India's fixed income market is showing some real potential in 2025. You've got controlled inflation, a government that's focused on fiscal responsibility, and all these factors that could lead to greater demand for Indian bonds. So it's shaping up to be a pretty interesting year for investors.
We've covered a lot of ground here, from the global scene to India's very specific economic position.
We have.
So where do we go from here? What's next?
Well, now we dive into the heart of it. What does this all mean for investors? What specific opportunities are we seeing emerge in India's fixed income market in 2025? Let's find out.
Okay, so we've laid out this global backdrop and we've zoomed in on India's economic landscape. But now let's get to the good stuff. What does this mean for investors, for folks like you who are listening? What specific opportunities should we be paying attention to in India's fixed income market in 2025?
Well, that's the million-dollar question, right?
Yeah.
And the report actually suggests something pretty intriguing. It predicts that the Reserve Bank of India, the RBI, might actually initiate a rate cut cycle, and it could start as early as their very next meeting.
Wow, okay. That's a bold prediction. Earlier, we were talking about tight liquidity and a potentially weaker rupee in India.
Right.
Wouldn't those factors usually lead to higher rates, not lower ones?
You're right to question that. It does seem counterintuitive at first glance, but the report highlights several factors that support this prediction. For one thing, by the next policy meeting, there will be a lot more clarity on inflation and growth numbers. We'll have more data.
Right.
Additionally, the union budget, which outlines government spending and revenue plans, will be released. And if the government sticks to its commitment to fiscal consolidation, as we discussed earlier, it gives the RBI more room to actually ease monetary policy. And then lastly, the U.S. political landscape will have settled after the new president's inauguration. So there's less uncertainty in global markets.
Okay, so the timing seems right, and the RBI might have the confidence to make a move, but how significant of a rate cut cycle are we talking about here?
Well, the report predicts it'll be a relatively shallow rate cut cycle.
Okay.
We might see a maximum of 50 basis point cuts over the next, say, 6 to 12 months.
So it's a measured approach then, rather than, a drastic shift.
Right, exactly.
Okay. So how does the credit cycle in India factor into all of this?
Well, the report points to the current moderation in credit growth and the low levels of non-performing assets in the banking sector as, positive signs.
Okay.
So it's suggesting a neutral stance on the credit cycle for now. But it does caution that this could change if growth weakens more significantly than anticipated.
So potential rate cuts, a relatively stable credit cycle, and a bond market with, these positive demand-supply dynamics. And it sounds like there's a lot to consider here. But for someone who's, maybe new to fixed income investing, where should they focus their attention? What are the key things to look at?
The report predicts that longer duration bonds are going to benefit the most from these anticipated rate cuts.
Okay. Can you maybe remind our listeners what exactly duration means in this context?
Sure. Duration is basically just a measure of a bond's sensitivity to changes in interest rates. So a higher duration bond will experience a larger price change when interest rates move compared to a lower duration bond. And when interest rates are falling, which is what's expected in India, longer duration bonds tend to perform well.
Got it. So if you're anticipating rate cuts, it makes sense to favor longer duration bonds in your portfolio.
Exactly. And this is where government bonds, often called G-SECs, become really interesting. They typically have longer durations than corporate bonds, making them a prime target for investors looking to benefit from a rate cut cycle.
So leaning into longer duration government bonds could be a strategic move in 2025. But what about those risks we were talking about earlier? How can investors mitigate those potential pitfalls?
That's a great question. And remember, it's not just about seeking returns, it's also about managing risk.
Of course.
And one of the best ways to do that is through diversification.
Okay, and how would diversification play out specifically in the context of India's fixed income market in 2025?
Well, don't limit yourself to just one type of bond or one specific sector. Spread your investments across different types of bonds, different maturities, and even consider international fixed income options. The key is to build a balanced portfolio that matches your individual risk tolerance and your investment goals.
So even within fixed income, you can build a more resilient portfolio that way.
Absolutely.
Okay, so let's remind ourselves of those specific risks the report highlighted. What were they again? And why are they important to keep in mind?
Okay, so the report flags 4 key risks to keep on your radar. Currency depreciation, potential changes in U.S. policies, a possible rebound in China's economy, which could actually negatively impact India, and then those lingering liquidity challenges we talked about earlier.
Okay, let's unpack those a bit. First, why is currency depreciation a concern for fixed income investors specifically?
Well, if the rupee weakens significantly against the U.S. dollar, it can erode the returns on your investments, especially if you're holding bonds that are denominated in U.S. dollars. This really highlights the importance of that global interconnectedness we talked about earlier.
Right, right. It can all come back to bite you.
Exactly.
So staying informed about currency movements is crucial.
Absolutely.
Okay. So what about those potential changes in U.S. policies? How could those affect India's fixed income market?
Well, remember those America First policies.
Yeah.
Depending on how they evolve, they could have pretty far-reaching effects. Changes in trade policies, interest rates, or even just the strength of the U.S. dollar can create volatility in emerging markets like India.
It's a reminder that, global events are all intertwined.
Yeah.
And they can have a domino effect.
For sure.
Okay, now what about the potential for a rebound in China's economy? Why could that negatively impact India?
Well, while a rebounding Chinese economy might sound like a good thing on the surface, it could lead to increased demand for commodities, which could push up inflation globally, affecting India. And it could also draw foreign investment away from India and back towards China.
So a strong China isn't necessarily a win-win for everybody.
Not always, no.
Okay, let's talk about that last risk factor, those liquidity challenges in India. What's the main concern there? Why should investors be paying attention to that?
Right. Well, liquidity basically refers to how easily assets can be bought or sold in the market without causing huge price swings. So when liquidity is tight, trading becomes more difficult and expensive, and that can impact your returns.
Makes sense.
So even if the fundamentals are strong, that lack of liquidity can create obstacles for investors.
Okay, so we've identified this potential for a rate cut cycle and favorable bond market dynamics in India, but we also need to be mindful of these potential risks. So what's the takeaway for investors here? What should they be thinking about as they, plan their investments for 2025?
I think the key is to approach the market with a balanced perspective. While 2025 holds promise for India's fixed income market, there are those potential pitfalls that we've talked about, and understanding both the opportunities and the risks is crucial for making informed decisions.
This deep dive has been incredibly insightful. We've explored the global landscape, analyzed India's economic outlook, and even uncovered potential investment strategies. But there's still more to uncover, right?
Indeed. We'll be back shortly to tie everything together and leave you with some thought-provoking questions to ponder.
So we've really gone deep on this topic, haven't we? Examined the global economic landscape, that whole picture.
Yeah.
And then we zeroed in on India, their specific economic outlook. And we even, I think, uncovered some potential investment strategies for 2025.
We did. We covered a lot.
What stood out to you the most, our conversation?
I think the thing that really strikes me is this convergence of factors happening in India. It's fascinating, really. You've got this potential for rate cuts, right? But at the same time, you have controlled inflation and then these positive trends we talked about in the bond market. Yeah. It creates a really, really unique situation. It's suggesting that 2025 could be a really favorable year for fixed income investors in India.
I think I agree with you. And it's interesting, the report's focus on longer duration government bonds as a way to capitalize on that rate cut cycle is a pretty valuable insight for investors. It really underscores, I think, just how important it is to understand those nuances of fixed income, like duration, how they can actually impact your returns.
Absolutely. It's not just about going after the highest yields out there.
Right.
It's about understanding how different types of bonds will react when interest rates change. Yeah. And as we discussed, if rates do fall, as predicted, The longer duration bonds are likely to benefit the most.
And of course, we can't forget about diversification, especially with those risks we outlined.
Right.
Spreading your investments across different types of bonds, different maturities, even thinking about geographies, all of that can help mitigate some of those potential downsides.
Diversification is really key, I think, to managing risk in any market, no matter what's happening out there.
For sure.
It's all about not putting all your eggs in one basket.
Right.
Creating a portfolio that really aligns with what you're comfortable with, your own personal risk tolerance, and your investment goals.
Yeah, absolutely. We've covered a lot of complex information today, global trends, India's fixed income market, all very nuanced. If you had to boil it down, if you could distill one key takeaway for our listeners, what would it be?
At the end of the day, the most important lesson for any investor is that knowledge is power. Don't let the complexities of the fixed income market scare you off.
Right.
Take the time to really understand what's going on, the dynamics at play. Stay informed about what's happening globally, what's happening in India, and assess your own risk tolerance. What are you comfortable with? And then develop a strategy that aligns with your personal financial goals.
That's a powerful message for sure. As we wrap up this deep dive, I'd like to leave our listeners with a final thought. Given all these insights we've talked about today, how might you adjust your own investment strategy for 2025? Could shifting towards longer duration government bonds, as the report suggests, be a strategic move for you? It's a question worth considering. And remember, it's going to depend on your individual circumstances how much risk you're comfortable with. The key is to really engage with these ideas, do your own research, and make informed decisions. That's what it's all about.
Exactly. And don't forget, this world, the world of finance, is constantly changing.
Always.
So stay curious, stay informed, never stop learning. That's how you achieve financial success.
Could have said it better myself. Thank you so much for joining us on this deep dive into the 2025 fixed income market. We hope you found this exploration insightful, maybe even a little empowering. And until next time, happy investing, everyone.